Welcome to TalkTickers, your go-to for breaking down the most significant earnings calls. Today, we're taking a deep look at the Q2 2025 performance of a global leader in commercial transport and infrastructure solutions, the Volvo Group.
Yeah, this quarter's call gave us some really fascinating insights, didn't it? How a major industrial player like Volvo is navigating, well, a pretty complex global economic landscape. They're balancing those immediate market pressures with the big long-term strategic shifts.
Exactly. We're going to unpack the numbers, listen to what management had to say. They were quite candid, and figure out what it all means, for the industry as a whole.
Let's get into it.
Okay, so let's unpack this. Management called it turbulent times, and yeah, truck deliveries were lower, but Volvo Group still reported a pretty solid Q2 overall. Net sales landed at 123 billion Swedish krona.
Which, yeah, that's a 12% drop year over year. Though adjusted for currency, it's more like 5%.
Right, but here's where it gets really interesting. They delivered a strong adjusted operating income, 13.5 billion SEK, which gives them a healthy 11% adjusted operating margin. That's pretty strong given the headwinds.
It really is. That resilience is notable. And operating cash flow came in at 2.9 billion SEK. Plus, the industrial operations, they kept a very robust net cash position, 43.1 billion SEK.
Solid numbers.
Definitely. Now, return on capital employed did trend down slightly, 25.7% on a rolling 12-month basis, but still, these figures really point towards effective cost control and strong underlying operations, even when things are challenging.
Right, that strong margin, it just underscores that disciplined management. So, okay, what does this all mean for the core business lines then? Let's start with trucks.
Yeah, trucks. Deliveries were down 10% in the quarter, mostly driven by North and South America, and sales, adjusted for currency, were down 7%.
So management mentioned under absorption from that lower demand, right? Basically, factories not running full tilt.
Exactly, which usually hits margins. But they emphasized, and this is key, strong cost control and a really robust service business helped keep earnings resilient.
That service business buffer seems crucial. Did you see a similar trend in construction equipment, or was that different?
Actually, quite different. It's a fascinating contrast.
Oh.
Trucks facing those headwinds, while construction equipment, sales saw a 1% increase adjusted for currency.
Wow.
And deliveries surged by 11% overall. A lot of that growth came from their SDLG machines in China. Those are their value-focused lines.
So that diversification is really paying off then?
Definitely acting as a shock absorber. What about the other parts? Buses and Volvo Penta?
Good question. Buses sales were up 1% currency adjusted. Pretty stable. And a major highlight they mentioned was the first delivery on that big contract for New York City's MTA. 250 buses. That's the start of their largest contract ever.
That's significant.
Yeah, and they also started producing an electric articulated bus chassis down in Brazil for global export too. Shows that EV push is still happening, just maybe selectively.
Mm-hmm.
But then you get to Volvo Penta, and this segment had an all-time high second quarter. Yeah. Sales up 12% adjusted for currency. Adjusted operating income hit 1.1 billion SEK, and the margin was 20.7%. Just stellar.
Wow, 20.7% margin. What drove that? Well, they pointed to strong volume in the industrial segment and also getting momentum back in the commercial marine business.
Makes sense.
And it's interesting, they're even making their marine IPS systems, that's their advanced propulsion system, available with fully electric options now. So innovation continues even where they're already strong.
Right. And the last piece, financial services.
Ah, yes, financial services. Pretty much steady as she goes, right?
Exactly. Credit portfolio grew 5%, currency adjusted, hit 264 billion SEK. New business volume actually hit a record for Q2, 27.8 billion SEK, up 9% adjusted.
And credit quality.
Still looking good. Delinquencies, write-offs, all under control. Seems like a reliable engine for them.
Okay, so that's the segment breakdown. But what's really fascinating here is looking beyond just the numbers, how the company is actively navigating these big macro trends and making some pretty critical strategic shifts.
Yeah, like that big one-time hit they took.
Exactly. A negative impact of 4.5 billion SEK. That's significant. And it was directly related to the slower than anticipated societal shift to zero-emission vehicles.
So writing down battery electric assets, renegotiating battery supply commitments, that sort of thing.
Precisely. And it really throws up a huge question for the whole industry, doesn't it? How fast is the world actually moving to electrify heavy transport?
Yeah.
Management basically said, look, policymakers need to step up and create the enabling conditions like charging infrastructure.
That 4.5 billion hit, It's a massive number. It sends a pretty strong message, right, about the pace.
Oh, absolutely. It's incredibly significant. It signals that the practical reality infrastructure, policy, even customer demand right now isn't keeping pace with maybe some of the earlier, more optimistic projections.
So it's a reality check.
A very pragmatic and maybe necessary reality check. Volvo's essentially saying, let's adjust our books to reflect the real timeline, not just the hope for one. It might even prevent bigger write-downs later.
What do you think that means for other players? Are they maybe being a bit too optimistic?
It certainly puts pressure on them to reevaluate. It shows building the trucks isn't enough. You need the whole ecosystem.
Right. And it wasn't all adjustments, though. They completed that joint venture, Corda, with Daimler Truck. That added $1 billion SEK.
Positive move there.
And in construction equipment, they're divesting their 70% stake in that China-based SDLG brand.
Shifting focus, it sounds like.
Yeah, focusing on more specialized, value-driven segments within China. But at the same time, they're boosting their European footprint.
How so?
Buying up dealer operations, Sweden, Germany, the Baltics, getting closer to the customer, strengthening service.
Ah, that combination. Divesting in one area, acquiring service capabilities elsewhere. That looks like a very deliberate strategy. Optimizing the portfolio, getting closer to those higher value customer relationships. Makes sense.
They also mentioned investing in crawler excavator production globally, trying to shorten lead times, improve resilience. It's all about making things more robust.
Okay, so what else are they seeing in terms of market dynamics? You mentioned North America earlier.
Yeah, North America, definitely a wait-and-see mood among truck customers. So they're continuing to adjust production down there to minimize that underabsorption issue, keeping factories efficient.
So they're holding their 2025 market forecast for North American trucks steady at 275,000 units, reflecting that caution.
Exactly. Europe, though, looks more stable. They said solid order coverage into Q4 for trucks over there.
Interesting regional difference. And what about tariffs? Any impact yet?
They flagged that, yeah. Said costs related to tariffs started building in Q2. Limited impact so far, but
they expect it to ramp up.
Yeah, expect the net negative effect to increase in Q3 and Q4 just because of lead times. They are working on offsetting it through pricing, though.
Okay. That pragmatic approach, again, reducing production where needed, managing cost, it really speaks to disciplined capacity management.
Definitely. And beyond all that, they highlighted something really cool on the tech front, autonomous solutions.
Oh, yeah. What was that?
They successfully hauled over 1 million tons of limestone autonomously for a customer up in Norway.
1 million tons. Wow. That's not just a pilot project.
Oh, way. That's serious real-world application. In a tough industrial setting, too. It's like they're quietly getting on with the future of industrial logistics.
While maybe others focus more on, say, road transport autonomy. Interesting niche focus.
Totally. And it fits with that broader theme, right? Strengthening regional value chains, boosting the service business, which, again, is providing real resilience right now. These acquisitions and divestments, they aren't random. It feels like a clear focus on segments where they can really lead, like heavy-duty construction and specialized solutions.
Indeed. And connecting this all to the bigger picture, Volvo's performance, their choices, they offer some key signals for the whole heavy industry sector. That big EV-related charge, for example, that's a critical data point for anyone betting on the pace of industrial electrification. It underlines that this transition might be, well, uneven. Demands flexibility.
Strategic flexibility, exactly.
Yeah. And their emphasis on needing government help, stimulus, infrastructure for zero emission.
Mm-hmm.
It's a reminder that this hockey stick growth we often expect for new tech, it usually needs external pushes, not just cool products.
Good point. It raises that question again. Are other companies being as realistic? Are they managing their exposure to this uncertain demand while also really shoring up their core foundational businesses like Volvo seems to be doing?
It's the key question, isn't it?
All right, well, that nicely sets us up. It's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, hedge fund style.
Okay, let's do it. Given everything we've heard from Volvo Groups Q2, here's a thought, maybe for the truly bold listener.
Yeah.
So Volvo was very upfront about the zero-emission transition being slower than hoped. They took that big impairment charge.
Right.
They also highlighted that cautious mood in North America, their focus on strong regional chains, that resilient service business, and those proven tech advancements like the autonomous hauling.
Okay, I think I see where you're going with this. Lay out the trade.
Consider a paired trade. You go long Volvo Group.
Okay, betting on
Their disciplined capital allocation, their willingness to actually face reality on the EV transition speed which might save them from bigger pain later, and that strong focus on core, profitable, resilient stuff like service and regional manufacturing.
Makes sense. And the other side of the pair, the short.
Simultaneously, you consider shorting maybe a pure-play EV charging infrastructure company, or perhaps a smaller, highly valued battery supplier.
Whose valuation depends heavily on...
Exactly. On an immediate and aggressive adoption curve for heavy-duty electric trucks. The very curve that Volvo's management just signaled, well, isn't quite materializing as fast as people thought.
Interesting. So the rationale is basically betting on Volvo's pragmatism versus potential market over-optimism on pure-play green tech.
Pretty much. Volvo's showing smart, disciplined management, almost old economy virtues, navigating this new economy transition. The short leg is a hedge against valuations elsewhere that might be, shall we say, ahead of the curve, especially in heavy transport, where the challenges are significant.
A bet on pragmatic adaptation. I like it. Okay, let's recap the whole deep dive then. Volvo Group's Q2. Overall, a robust performance, despite, a turbulent global environment.
Definitely driven by strong operational discipline, those strategic adjustments to market realities, and a clear focus on long-term resilience, especially through service and targeted innovation.
Yeah, the insights from their call, they offer some valuable lessons, I think. Navigating uncertainty, balancing growth and profit, and really adapting to the actual pace of tech transformation in heavy industry.
Absolutely. It's a case study in managing complexity.
Well, thank you for joining us for this deep dive. We always love to hear what stands out to you, the listener. So feel free to reach out with your thoughts. Maybe what aspect of Volvo's strategic resilience did you find most compelling? Let us know. And just the usual reminder, the content you heard today was for informational purposes only. It should definitely not be considered financial advice.
Nope. Always do your own research, or please consult a qualified financial advisor before making any investment decisions.
And please note, this deep dive was generated with the help of AI. While the insights are based on factual data from the earnings call, the presentation might include some creative commentary for engagement.
We make no representations or warranties about the accuracy, completeness, or reliability of anything presented here. Always, always refer back to the official company earnings reports.
Until next time, stay well informed and keep diving deep.